Hi, everybody. Good afternoon, and thank you for joining our Hawaii Economic Association webinar. My name is Lesley Harvey of the Hawaii Business Consultancy and board president of the Hawaii Economic Association. This month, we've restructured a bit, as you've likely noticed. Thank you to those members who are joining us, and thank you to those non-members who have purchased $5 Q&A access. Also, thank you to those who are joining us via the Facebook live stream. As the virtual platform becomes more commonplace, it's likely that we will continue to make changes and adjustments in the future. We appreciate your grace and willingness in navigating these adjustments with us. A special thank you to those who donated to our student fund and our general donation fund. One second here, okay. Your generous contribution allows us to continue to provide these events without operating at a loss and supporting student access to events and student support. We're glad to be delivering economic education, information, and resources. This month's event, Housing After the Pandemic, Threats and Opportunities, featuring Phil Garboden, provides information on the immediate risk for housing security and the rental housing market, as well as long-term implications and housing solutions. Following the presentation, we'll have a Q&A session. We encourage you to use the Q&A function. Feel free to send comments and upvote questions at any time. I'll solicit questions as time permits, prioritizing questions with a significant amount of upvotes. We've also enabled a few polls, one that you saw here at the beginning and one that we'll also publish at the end of this presentation for those of you joining us via Zoom. Your submissions are anonymous. A window will pop up as you saw, and we ask that you take a few seconds to respond. This feature is limited again to those who have joined us via a Q&A access ticket. At the end of today's webinar, I ask that you take a few minutes to let us know how we did. Before you leave, check the chat function for a link to your feedback form. All registrants will receive the link via email as well. You will also receive the slides and a recording of the event next week. If you haven't yet registered, please do so at heaseptember2020.eventbrite.com. Before we get started, I wanted to also plug our Facebook presence. Please find us on Facebook at Hawaii Economic Association. We so appreciate you sharing our event flyers and supporting our mission of supporting economics in Hawaii, or even just liking our post. Next month, I hope you'll consider joining us for our annual conference, a 2-day online event titled Finding Hawaii's New Economic Equilibrium. Each of the 2 days is from 8:30 to 12 p.m. and includes a keynote speaker and 2 panels. Day 1 on Wednesday, October 7th, considers how Hawaii can realign market forces to support a more sustainable tourism industry, the costs and benefits of tourism, and the unique characteristics of each island's tourism economies. Day 2, Thursday, October 8th, explores Hawaii's past efforts and promising future with economic diversification. We hope you'll consider joining us. Registration opens soon. Now, I do want to let you know that as we've made adjustments, we found that the virtual platform has allowed us more opportunity to provide benefits to members. As you found today, free access with the opportunity to pose Q&A questions was limited to our HEA members. Member attendees to the conference will get a special bonus in the form of the November and December webinar events bundled as part of their conference package. We had so much that we wanted to cover during the conference that we decided to extend a few of the panels into November and December to close out the eventful 2020 year. As a special incentive to join HEA, conference registration provides a special rate on HEA membership. To entice all current members to renew for 2021, as well as non-members to consider joining HEA, we will be offering a special rate on 2021 membership dues. Instead of the usual $40 annual fee, we're offering a limited special rate of $30 for the year, which includes membership pricing for the conference, November and December events bundled, and of course, member pricing and all of the benefits that come along with membership for all of 2021. This price will only be available during conference registration. You'll be able to purchase membership dues with your conference ticket. Non-members will still have access to our events, though preferred access, for example, the webinar Q&A, will be limited to our members. We anticipate more benefits in the future as we continue to adjust. Now, before I turn it over to Phil, let me properly introduce you. Phil Garboden is the endowed HCRC professor in affordable housing economics, policy and planning at the University of Hawaii at Manoa, serving in the Department of Urban and Regional Planning and the UH Economic Research Organization. Broadly construed, his work considers how supply-side actors, such as landlords and real estate developers, respond to housing policy. And with that, I am going to turn it over to Phil.
Wonderful. Thank you so much for the introduction. I'm worried that perhaps my video is not functioning at the moment. So let me see if I can share my screen at least. All right, let me try to get my video up and running here for 1 second. While I'm doing that, I will thank you guys for having me as part of this, and also for the many people who went into thinking through some of the questions relevant for this talk. That includes members of the House Select Committee on COVID-19, Housing and Homelessness, for their various wisdoms, as well as Isabel Picciotto for her research assistance, and members of the UHERO forecast and analytics teams for doing what they do. Sorry. I'm not sure if I can answer this question, but is my video not functioning on your guys' screen as well? I apologize for this. Someone could pop me some information on that. That would be great.
Phil, I don't see it, but that's okay. You can go ahead and keep going.
Okay, you can hear me though? Okay, good. That's what I can at least heard, which would be good for this. But you'll have to deal with a still photo of me. Hopefully the Q&A, I'll get it working. All right, so today I want to talk about sort of the 3 stages that I see of dealing with housing and the pandemic. The first is what we're in now and have been for quite some time, which is the process of avoiding displacement during the pandemic, right? This idea that regardless of the economic consequences, there are epidemiological consequences associated with disruptions to household life, and something that we need to be taking most seriously at the moment. Second is how we support families during what I think most economists believe will be an extended economic downturn or recession that's going to hit disproportionately Hawaii over and above mainland states due to our dependence on tourism. And third, how do we potentially operate in an opportunistic way to build a housing system going forward? I wanted to start with this sort of statistical question of what can we see is going on right now, right? What is the sort of current information we have on the ramifications of the pandemic? Sadly, the data here isn't great, particularly data on the rental market. What we have is often quite hard to generalize or even hard to interpret, but I'm going to do my best to sort of paint a picture of what maybe we do know at the moment. First, let's look at renters. This is data from the Census Pulse study. The Census Pulse study, which was ceased or temporarily pulled offline and sort of is being rethought, ended at the end of July. So we don't have August data on this, unfortunately. But it's surveyed a random sample of residents here in the state, indeed nationwide, and asked some sort of basic questions about how they were faring economically during the pandemic. There's sort of 2 main questions related to housing on it. One is this sort of general question is how do you feel about your housing stability and security, your ability to pay rent going forward? And the other is what I think of as a much more concrete and indeed sort of answerable question for the respondents, which is, have you paid last month's rent? And the data, as you can tell from these lines, is super messy. You would expect more sort of within month periodicity here than you're seeing, which always makes me suspicious. But I think the general trend here is that about 10% of renter households, this is at the household level, have had trouble, have not been able to pay their rent on a given month. They may be paying it eventually or a month or 2 late, but at any given time, about 10% of families are a month late, and that number is much higher when you look at larger households. So households with 4 or 5 people in it, compared to single people living, renters living alone. The larger households are much higher arrears rates. Obviously, they sort of jump up and down here, but in general, you can think of them as about 10 percentage points higher on average. We've also been scraping consistently data from Craigslist, sort of the easiest apartment listing site to scrape to see what we can see in terms of what's happening with volumes and rents and so forth. The chart on the left, it just tracks the median listing price for a 2-bedroom on Oahu, going back to October 2019. And, I could tell a story that explains those various ups and downs, but I think in general, truth is for right now, we haven't seen enormous movement on rental housing prices yet, right? What we have seen pretty straightforward movement on is the number of postings per week, the number of rental listings, and the mean number of bedrooms that those listings represent, right? So if you look at the middle chart, you can see that back in January, you had just over 1,100 listings every Wednesday on Craigslist, and that's dropped to under 900 in the most recent scrape. What seems to be not being listed are larger units, right? So over time, the number of 1-bedrooms, 2-bedrooms, studios and 1-bedrooms have remained fairly consistent, but the number of 2-bedrooms and larger units have gone down. And I think this story is less about the economy and more about the realities of what it takes to move during a pandemic. I have a family of 5 myself, and I wouldn't dream of trying to make anything but an emergency move at the moment, where as my students who are single folks are much more able to move around fairly easily. So turning to homeowners for a second, we can see that we actually have a fairly similar story in terms of rate of homeowners who are not current with their payments. Prior to the COVID crisis, basically everybody was current on their payments here, as might be expected, and that's jumped to around 10% as well for those families. And this is data from the UHERO frequent data analytics system online. Anyone can get to this data. We also track things like mobility, passenger arrivals, things like that, and I strongly recommend you availing yourselves of these really interesting charts. In terms of housing prices, we're starting to see what had been a plateauing of housing prices is now resulting in a slight dip. You can see here, this is the Zillow Home Value Index, which shows a little drop since COVID hit. And perhaps more reliable data comes from the Honolulu Board of Realtors, who are showing that year-over-year declines in both number of sales and median sales prices of around 3%. Condominiums are down substantially more in terms of number of sales, and also more in terms of sales prices. So, this is not catastrophic. This is not 2008, or 2008 on the mainland, I should say. But, we are seeing a softening of the market to some degree, and I think we're anticipating that's going to continue. So moving on to what will happen, my caveat is that all of these data sources right now are showing you a market that isn't operating just in response to economic factors, right? Not just in response to the labor market, but also to a number of epidemiological and legal factors around limits to mobility. It's very hard to look for a house right now. It's very hard to move, all of those types of things. So, we don't want to be too eager to extrapolate from little changes that we see over the course of the pandemic. And I think it's more general to think sort of more theoretically bigger picture. The one thing I think we're pretty confident about, and this is borrowing from the UHERO forecast reports, this is another great resource for folks, is that we're anticipating that was a modest 3-year decline in population here in the state is going to continue and indeed even accelerate for the next couple of years, right? If we have an economy here in Hawaii where the jobs are, are not coming back at the rate that they're coming back in the mainland, and despite the high transaction costs of exiting the state and moving to the mainland, we're going to see more and more appeal to do so when people leave to pursue employment that they don't feel or isn't coming back here. So you can tell from this, these are 3 scenarios listed here. The green is sort of what you hear us predicting as the baseline, maybe the most likely line, the pessimistic scenario is a substantial drop in population, and a more optimistic scenario. So we try to provide all three, so we're showing sort of range of possibilities here. But in either account, we're looking at a drop from 1.4 million to 1.39 million, which is quite a substantial number of people when you think about the time frame here. All right, so moving on to more speculative thoughts about the housing market. Will the market soften? As I said, I think it probably will. I think that the likelihood is that due to this population decline, due to income effects, right? People are earning less, they're going to downsize their housing, they're going to try to consume less housing if that's at all possible. And what we may be seeing as a final sort of force majeure enforcement of the STVR regulations is going to reduce those numbers, which will open up more stock. So for all three of those reasons, and without a large countervailing idea, I think the market is going to soften. Does that mean that rents and housing values are going to go down? Possibly go down, plateau. Both would be a softening of our market here. I don't anticipate this happening in a severe way, at least not for the next 3 or 4 years, because most of the fundamentals related to our high housing prices, the amenities of living here in Hawaii, there's the cost of building, the limited land, the regulatory environment, so on and so forth, so they're still going to remain in place. And so I'm not seeing sort of a precipitous decline. I doubt that really any homeowners will find themselves underwater or any of those types of concerns that we saw during the Great Recession and the housing market collapse. It's also important to reflect that I don't think all sectors are going to be equally impacted by this, right? I think what we're seeing, and this is highly anecdotal at this point, is that we may have increased demand from wealthy mainlanders that's going to bolster our higher end home ownership markets, right? Folks who are sort of fleeing density in light of this may choose Hawaii as a likely candidate for that. And I think that'll come up again when we think about the consequences of all this for the rental market and the sort of what replaces potentially obsolete properties. We also may see, and I'll talk about this a little bit, a loss of supply of modestly priced, unsubsidized rental housing, what some folks call naturally occurring rental housing, right? Landlords who were marginal to begin with, and due to the complexities of the COVID situation, may be inspired to sell their homes, particularly if they have single family rentals. And therefore, there may be a supply drop in that, which would mitigate the softening of the market in that sector, which is unfortunate because that's, of course, the sector in which, in some ways, the market is needs the most softening. All right, so what should we do about this? And I think, I wanted to be a little more optimistic too, is how can we take advantage in the benevolent sense of this situation, right? How can we look at some of these factors as potential opportunities in terms of building a housing system, more robust housing system? So returning to the three-part sort of sector here, I'm going to give one recommendation for each. I think anything more than 3 recommendations, I could, of course, give 70 recommendations, but anything more than 3 is probably an overwhelming amount for a talk. So I'm going to give 3, one to sort of talk about each of these 3 stages, right? What is the recommendation related to avoiding displacement during a pandemic? 2, what is the recommendation related to supporting families during an extended recession? And 3, how do we build a better housing system going forward? So I'm going to start with the public health crisis, right? The avoiding displacement question. As I'm sure all of you are now aware, especially if you own rental properties, a couple of days ago, the Center for Disease Control surprisingly issued a national eviction moratorium, one that, if interpreted generously, covers far more folks than previous national moratoriums, such as the one issued by the Department of Housing and Urban Development. Right, as long as a tenant truthfully asserts that they are making the best attempts to pay rent, make partial payments, and seek support programs, that tenant cannot be evicted. There are a bajillion, to use the technical term, questions about this particular rule, how it's going to be enforced, whether or not the CDC has standing to do this, right? This is obviously not a normal thing that the CDC is doing. To be so involved in the housing market is also not a normal thing for the federal government to be doing in general. So no, I don't think anyone is going to be surprised when this moratorium gets challenged in court. And I think only time will tell what the outcome of this is and how the moratorium will be interpreted by state and local municipalities in terms of enforcement, right? Here, of course, we have our own moratorium, and this does not supersede that. And so there's going to have to be sort of a blending of the stronger aspects of one and the stronger aspects of another to sort of sort all of that out. But let's go with a tentative yes, that this will be allowed to go through until January 1st, which is when it's set to expire. And therefore, assuming that a tenant is experiencing hardship through COVID, that displacement, involuntary mobility is potentially off the table. In terms of homeowners, I think we're also seeing, again, until January 1st at least, a fairly strong system to protect from the epidemiological consequences of displacement, right? The majority of homeowners here purchase their properties in ways that their loans are securitized through a GSE or through FHA, VA, et cetera. All of those folks are strongly protected currently from foreclosure and so forth. The rest of the folks here have their houses, usually because they're jumbo mortgages and so forth, are securitized locally or through a third party. You know, here in my conversations with local lenders, my understanding is that most of the mortgage servicers locally have no interest in repeating the mistakes of 2008, which they largely avoided here to begin with, and will work hard to keep homeowners in their homes. So I don't see a worry, especially given the timeline that any foreclosure would take, even if you have a mainland lender who is not willing to work with you, of seeing homeownership displacement. It seems like an unlikely category. But what's missing from all of this, right? Again, from the epidemiological perspective, and that is that there's still this problem of rent arrearage, right? Explicitly stated in the CDC's mandate is that they are not calling for any sort of a rent jubilee or a rent reduction, that landlords are still allowed to charge their tenants full rent each month and could potentially result in larger arrearages on January 1st, right? Arrearages that would be so substantial that no matter what employment comes back and when, a tenant could not pay their way out of it, right? Now, I think the majority of landlords here are not going to take that incredibly punitive option, right? It doesn't make, to me at least, any sense from a business perspective. I think most will understand and work with their tenants. But of course, the more that they're willing to forsake rent arrearage, the more challenges we have around the preservation of the rental stock, right? So in one way or another, whether it's very harmful for tenants or very harmful for landlords, this rent arrearage problem nonetheless remains as a critical one that needs solving. Right? It needs solving so tenants don't end up with a bill they can't pay on January 1st, and it needs solving so that landlords stay in a position where they can preserve their unsubsidized rental inventory. I think the last thing that Hawaii needs is a loss of rental housing here in the state. And I would say that we don't have great data on this rent arrearage, as I mentioned earlier, and I'm working with the Honolulu Board of Realtors and the Kauai Board of Realtors and folks at the Big Island to initiate a survey of landlords to try to capture what this is and try to estimate this need, so we can make the political case around supporting back rent. So that should be coming out in the next couple of days. So I strongly encourage folks to fill it out if you happen to be a rental property owner or know them, send it to them, all those types of things. So, all right. The good news here, right, is that this problem is that we actually do have quite a bit of money already earmarked to address this problem, right? Normally we're in the sort of situation as having a problem that we need to figure out some kind of cost neutral way of solving it as a public policy as a public policy. But here, between state and county, the sort of lowball figure, and it's actually probably much higher than this, is that we have dedicated about $125 million, again, all of which to be expended by the end of the year, to cover rent arrearage and folks who can't afford to make their rent. The recommendation here is simply to get that money out as quickly as possible. I know folks from the state and the counties have been working, overtime squared on trying to figure out ways to get that money out as quickly as possible. The folks that I know have all been very dedicated to making this happen, but sometimes institutions have a way of undermining the best desires of the people within those institutions. And so anything that we can do to sort of be pushing that money, making sure it gets into the hands and being proactive about that, right? The biggest issue is, even if the money's ready to go out, if tenants don't know about it, if they don't understand what they need to do to get it, if landlords don't know about it and don't know how to encourage their tenants to apply for it, there's always going to be struggles in terms of getting it into the right places. So as much as we can sort of work together on a sort of public information campaign, direct outreach, and so forth, is critical here. So that's sort of, I think, actually largely good news for the epidemiological thing. We have the protections in place, we have the money in place to resolve most of the rent arrears problem, and it's more about implementation at this point. Not to make that sound easy, but at least many of those barriers are already in our rearview mirror. It gets more challenging when we move on to the supporting families during the recession, right? We have sort of a paradox here of housing, right? It's not really a paradox if you think about it very hard, but it sort of can be perceived as a paradox, which is that Hawaii has one of the lowest eviction rates in the country, right? The data on eviction rates is really bad, and even sort of attempted aggregating sources like the Eviction Lab do a mediocre job, and a lot of states are flagged as sort of, we don't think this is right, but it's the best we can do. Hawaii is one of those states, so I sort of corrected it based on better data. But even with that correction made, we still pale in comparison to places like New York, Massachusetts, which much have a higher eviction rate per renter household. And of course, we're well below places like Virginia and North Carolina and South Carolina, which have massive things. So we have very, very low eviction rate comparatively, right? But we have incredibly high housing costs. So how do we square this paradox, right? And the way we do that is, I think, the simple truism that if there is any money coming into a household, right? If there's any money, income whatsoever, that money is going to first and foremost go to rent in 99% of cases, right? I think, there's always exceptions to any truism, but in general, households that have working members, have income, will prioritize rent, sometimes at the expense of other necessities, and pay their rent to their landlords. And landlords here, I think, are perhaps uniquely willing to work with tenants who are struggling during short periods of time. So between those two factors, I think we haven't really thought much about involuntary housing mobility, housing stability, or housing instability, involuntary housing instability here as a state, because we have a need to, right? If you look at our unemployment rate, this is our unemployment claims, but it's sort of the same thing. We've been at full employment or close there too for quite a while, right? And so folks who are expected to be working are working, and therefore their rents have been getting paid, even if they're struggling mightily, right? And making other sacrifices to afford their housing. They've had some income, and some income generally goes to rent first, right? But we're about to sort of enter a new era for this, right? You hear us projecting that jobs will still be below baseline, baseline meaning 2019, in 2024, right? So we're about to enter a radically different period in terms of housing stability, right? There will be many households for the long term, for the next 2-3 years, that aren't receiving any income. Things like unemployment, no matter how large the next stimulus is, et cetera, will probably start to dry out, and we're going to start to see households struggling to make rent from any means, right? So my recommendation there is that right now we think of a lot of housing subsidies, or at least individual-based housing subsidies as a state, as primarily a homelessness policy, right? This is something that is particularly acute given our high levels of unsheltered homelessness in the state. And so a lot of the way we divide up our housing policy landscape is the things that directly support renters or low-income homeowners are thought of sort of homelessness prevention at best, and or directly as a way of moving people out of homelessness. And obviously that's all critically important. But I think we need to start making the mental shift around that, at least for the next 5 years, away from this idea that there's a group of homeless people who need housing subsidies and a group of people who don't, because we're going to see a much, much larger group of people in need of income support. Ideally just straight up income support through UI extensions and things like that. But if that doesn't work out, then housing support to avoid the sort of direst implications of a lack of income, right? So I think, again, hoping optimistically that we get more funding from the federal government, particularly as one of the hardest hit states by this whole situation. I think we need to really think about how we can retrofit existing housing policy infrastructure, right? Programs that are already in place, already have the systems by which income is verified. This is less of the critical emergency that we're in right now and more of a process of how can we support people long term. And so thinking about something like the Housing Choice Voucher Program, which is, generally reaches the lowest income families in our state, can be retrofitted a bit, made changes, and be transitioned into a housing stability, housing preservation, stability preserving tool going forward in ways that don't require us to entirely reinvent the wheel, and as a way of supporting these families whose jobs may not be coming back for 2, 3, 4 years, and whose other choices invariably will be out migration, moving to places where the jobs have come back, or where at least they believe the jobs have come back. All right, 3, and this is, I think, where it gets a little more inspiring, is how do we build a better housing system going forward? And there's a lot of things here and a lot of things that haven't changed at all on COVID, but I'm going to focus on 2 things that I think are really opportunities that emerge from the particularities of the COVID crisis. And that's the possibility that there will be small hotels that fall out the bottom of the market and maybe looking to sell and can be converted. And what I think is almost certainly true, the reality that some portion of the naturally occurring affordable rental stock will fall out the bottom of the market due to the strains of being a landlord during these times, and that will need to be captured by policy in order to avoid conversion out of the rental stock, right? I don't think there are going to be a lot of people entering the rental market, so we need to, right now, so we need to make sure that people aren't leaving the rental market to the degree to which we can move the needle, right? The degree to which we can sort of use policy nudges to keep folks here. And so the 2 sort of buzzword terms here, or the official IRS terms, I should say, are adaptive reuse, which you turn a hotel into housing, or acquisition rehab, where you turn housing into housing, right? The second just being a pure preservation strategy based on the sort of maxim of a penny saved is a penny earned, right? And the first being a creative way to make use of the benefits of existing structures and convert them, if we're seeing a prolonged dip in tourism, out of a hotel, which would then be competing with other hotels for a reduced number of visitors, into something that we desperately need for long term, which is more affordable subsidized housing, right? And there's enormous complexities involved in doing each of these, and they're not easy. The one major comment I get when I talk about these is that, this idea of like, well, we are going to see a return of tourism, of course we are, right? And we are going to see, the same sort of market fundamentals. And so, why do you assume that like suddenly there'll be hotels you can pick up on the cheap as you walk down the street, right? And my answer to that is, of course, I don't assume that, right? Is that we're looking at the marginal properties. We're looking at the hotels and rental properties that are already struggling, have already, near the end of their sort of useful life, right? And are sort of accelerated into obsolescence through the COVID crisis, right? And we don't need 1,000 of these things, right? We need 1 or 2 that we can be strategic about, or ideally more than 1 or 2, that we can be strategic about and acquire and convert, right? This isn't about the end of tourism. This isn't about the end of the rental market. It's about making sure that the properties that have been accelerated out of these particular markets get picked up and converted to something that helps people stay here in Hawaii long term. All right, so how do you do that? Well, there's two big things you need to do, and either an adaptive reuse or an acquisition and rehab project. The first is that you need additional funding streams that are flexible and opportunistic, right? I think one of the things we often don't think of when we're thinking about building new affordable housing, although we should be, is the timeline it takes to do that, right? It takes years, if not decades, to get an affordable housing project from, vision to something someone can move into here, right? And, as much as that has catastrophic consequences in terms of the costs of building that affordable housing, it doesn't mean that that opportunity is entirely forsaken. It just takes too long and it's too expensive. When you're dealing with something that involves capturing properties that are falling out of the bottom of a market, you can't be operating with a timeline that you can't be operating with that kind of timeline, right? Because you will miss the opportunity, right? Someone else will buy the walk up in Mo'ili and build condos on it, right? Or convert it, or perhaps preserve it as rental property, or more likely build condos on top of it. Somebody will buy the hotel that fell at the bottom and retrofit it as a different type of hotel by holding it for X number of years, so on and so forth. So unless we can be opportunistic, unless we can be flexible to respond to these opportunities as they come through, we will miss those opportunities, right? And I think there's also a mindset shift that we need a little bit in terms of the way that the state and county's process of allocating funding for affordable housing. We need to think of it in addition to the new stuff that's built. We also need to more, especially over the next 5 years, more intensely embrace a preservation-oriented strategy, right? Because it doesn't matter from the sake perspective of a tenant whether we have 100 more properties or we don't lose 100 properties, right? As long as the sort of dollars are the same to do both of those things, which is also complex, there really should be no difference between preservation and new construction. If you build 100 but you lose 100, then you're back where you are, right? So it operates all the same way. So we want to make sure that we have these policies in place in the way that we allocate funding for affordable housing that allows us to be very flexible and very focused on the needs of the next 5 years so that we don't miss the opportunities that are going to almost certainly avail themselves. If they don't avail themselves, then that means the economy here is doing terrific, and therefore we can go back to the other sort of processes that we're doing, right? But if they do avail themselves, we want to make sure we're in a position to capture them. All right, so just my summary here, 3 recommendations, right? In terms of the epidemiological problem, get the money out to cover this rent arrears problems. The moratorium on eviction and the protection for homeowners do not solve the problem entirely, right? And indeed, if not complemented with rent support, will result in sort of a perfect storm for both tenants and landlords in the negative, right? Despite accomplishing the epidemiological objective. 2 is consider how to retrofit existing infrastructure to serve families during a recession. Shallow subsidies, things that preserve housing, for several years. Subsidies that are structured in such a way that you can get out of it, right? Like once you get your job back, you don't get it anymore, then that subsidy can be used for someone else. All of these things are built into existing programs, and we can go forward. 3, prepare a pipeline for regulatory and financial for both adaptive reuse and acquisition rehab projects, right? I think those are my 3 sort of COVID-related recommendations to address 1, 2, 3, although dozens of others could just as easily be up here. So with that, thank you, AJ, and everyone for listening. And I suppose it's time for Q&A.
Yes, thank you, Phil. Thank you so much for that really interesting, deep look at the housing crisis during the pandemic and what we might do. We have a number of questions. I want to encourage our Zoom attendees, if you do have questions, enter them into the Q&A and upvote those that you want to see answered. So I will get right through them here. So first question, Phil. In a prior HEA event, Senator Chang admitted that a pro-development stance is political suicide in Hawaii, and that this prevents anyone in office from meaningfully increasing housing supply. Do you think that the many changes brought on by the pandemic will have any impact on this political roadblock? Phil? Can you hear me, Phil?
Great. Can you hear me now?
Oh, yeah, we can hear you, and your videos there too.
Apologies to that. This system I have started to crash without my knowing, so I need to solve that problem. Yeah, so I mean, I think we need to think about pro-development and what that means, right? And I think a lot of people think that means absorbing green space, you know, absorbing land that isn't otherwise built or is rightly controlled by the Hawaiian groups, or all these other things, ecological consequences things, right? But pro-development can also mean density, right? Both of the sort of adaptive reuse and the acquisition rehab, not a single parcel of undeveloped land for either of those ideas is consumed, right? It's simply converted to different use that benefits people more. So I understand political ramifications. I also understand all of the things, but I think there needs to be a little bit of messaging around what development means, what it's meant historically here, which has been very different from, I think, what a lot of the folks are talking about doing these days, right? And indeed, like without density in urban core, it's struggle to think of ways to solve the affordability and the obligation problem at scale, right? So I defer to Senator Chang on the political implications and the ideology, but there's so much that we can do that does not necessarily involve all of the things that we think of when we think of development here. And primarily the one word that I use for that is density, right?
Yeah, Phil, you know, the sound has gotten a little bit, kind of is going in and out. So I'm going to try cutting your videos. Sometimes that just opens up the bandwidth a little bit. So we'll try that for the next question here. Sorry to everybody. I don't want to cut him, but I want you to be able to hear his responses. So next question, we have housing vouchers through the Section 8. It's not perfect, but many landlords don't take it. What would make this voucher system different?
That's a great question. A very long report on the HUD website that I wrote, but that'd be a good question. How would you reform the voucher program? I will say that there's a lot of, there's quite a lot of low-hanging fruit there of things that would make the program work better for both landlords and tenants, right? I think that there's sort of this assumption that anything that makes the program more attractive to landlords somehow makes it worse for tenants. And there are issues in which those trade-offs need to be confronted, but there are also issues where that it doesn't need to be confronted. And you know, the things that come up the most when you talk to landlords about the voucher program are the challenges related to move-in timelines and inspections, right? When you want to rent to a voucher holder, how long does it take before the paperwork gets approved and that tenant is in there? If that takes more than a month, then it's a month of rent that you just like lost, essentially, that you wouldn't have lost if you rented to a market rate tenant, right? Inspections are overly onerous, overly capricious. They result in frustration from landlords who then choose to voluntarily exit the program, right? And so those things are fixable, right? Those are things that systems can fix, right? There are all sorts of programs out there around inspections where sort of good, you know, if your property passes inspection perfectly every year, then you get to do it every 2 years, then you get to do it every 3 years or something like that, right? There are ways to sort of simplify the inspection protocols that result in the same level of health and safety protections to tenants without what landlords feel as the sort of capricious aspects of that. I also think there's a lot of messaging that I think we're in a moment to be clear about, which is vouchers provide guaranteed rent regardless of the economic circumstances, right? So if I had voucher tenants 7 months ago, right? So long as there may be some challenges collecting the tenant portion of the rent, but those challenges can be addressed by going to your local housing authority office, doing an income assessment and adjustment, and reducing the payment for the tenant if they stop originally along the lines. And so in every meaningful way, my income stream is pretty much entirely protected if I hold vouchers, right? And I think we often focus on the challenges of vouchers and not the sort of like positive aspects of it. And so helping market vouchers as the solution to some problems for landlords while removing the problems that the program creates itself, I think go a lot of promise. And I'm working on a bunch of very early on projects around evaluating various landlord outreach programs in the voucher program. But so we don't have great answers about specifically what yet, but I think there's a wide road forward there.
Okay, thank you for that. And in terms of variation in rental price dropping, do you anticipate that rents may drop, but not to the same degree depending on the quality of the unit? So for example, high-end rentals will drop a lot, but mid-range rentals or low-price rentals, maybe not by so much. What do you think?
So it depends on how the implement plus up works long term there, right? Which groups are covered and which groups aren't. I think at the very bottom of the unsubsidized rental market, I think you're going to have the least ability to pay for tenants, but you also might have fewer rental properties in that, right? I think in the more high-end rentals, I actually, depending on what we mean by high-end rentals, right? If we mean like actually high-end rentals, I don't think we'll see much movement there because the types of jobs that people in those are occupied are probably pretty stable, right? But the sort of next tier down, we are seeing reductions, people, 2 full-time earners, but not necessarily, not a labor adopter, right? Those folks are particularly vulnerable at that moment, and so I think there might be some reductions there. So there's a lot of sort of contingencies there as well. But what I worry about is things at the bottom of the housing ladder falling out because that's going to be the tenants who are least able to pay. If there aren't enough income supports in place to make that happen, those landlords are going to suffer the most, the strongest economic losses. And again, especially if it's single family, but even if it's not, just getting out of the rental business to a more healthy homeownership market and just sort of cashing out in that way is going to be pretty tempting. We need to make sure that doesn't happen.
Okay, thanks for that, Phil. What are your thoughts on the lack of eviction activity noted by Salim Firth using data from the Eviction Lab? And do you think that this is relevant to Hawaii's eviction activity or non-activity?
Yeah, I mean, the data is really hard to understand right now. In Hawaii, for instance, and in a lot of states, right, it's been against the rules to file for an eviction, right? So we don't have a good sense of how many rental properties are essentially at risk for eviction, or how many rental tenants are at risk for eviction, and how many are have landlords that have already worked out payment plans and so on and so forth, right? There's no way to see that in any data that's recorded. Hopefully the survey that we're doing, the realtors will help us get some access to that, right? But there's a lot of invisibility to that space right now. Again, my sense, as I said, is that most landlords are not foolish, right? And, evicting large percentages of your tenants is not when there's not anyone to replace them with that isn't in a similarly dire economic place is just a not good business sense. On top of that, a lot of landlords are good people who understand that we're in this as a community and are going to work to this. So I think some of the messaging that just sort of assumes landlords seek to be as punitive as possible is a false understanding, whether you assume they're rational actors or just human beings, which they're both. But I do think that there is a need to be tracking this, right? Because, as I said, until January 1st, we have decent supports in place, right? Assuming we can get that out. After that, I think we're going to see a long-term decline. So, yeah, I think that answer on that eviction data right now is very complicated to interpret for whatever reason, as it is here, almost entirely a black box here.
Thanks, Phil. And we're still having just a little bit of wobbliness with the sound. If you might just get really close to your microphone, that could alleviate it. It's just every now and then it sort of comes and goes. So next question, could you elaborate on your thoughts on loss of supply of moderately priced rental vis-a-vis the vacation rental market changes? Pre-pandemic, the loss of legal vacation rental would be putting more supply on the housing market.
Absolutely. So the question is what happens to vacation rentals, right? That's a huge question that I don't have a specific answer to. Right? Some of them will become long-term rentals. That will be a mitigating factor in terms of the loss of the sort of moderately priced funds.
Bill, the sound has gotten really impossible to hear now. Could you try coming a little closer to your mic?
Yeah, sorry.
Oh, that's actually way clearer. That was better.
Oh, okay. You can hear me better now?
Yeah,
okay.
That's perfect. Thank you.
So what I was saying was what happens to the vacation rentals is a huge question right now, right? And the big issue is if they become rentals, then I think, you know, as I said, that's a mitigating factor in these other reasons why that we might lose rental stock, right? So we'll gain rental stock from the vacation rentals and we'll lose rental stock for the more marginal properties that have struggled through this pandemic. You know, I don't have a great prior. Again, there isn't great data here. You know, I think a lot of the vacation rentals might end up in home ownership. A lot of them might be, you know, if it's a single family vacation rental in a desirable location, you might look at the rental market right now and be like, oh, that seems really dodgy, right? For the next couple of years, you know, but I can sell now at a pretty good, robust price. I feel like that might be a likely outcome for a bunch of them. So a lot of that depends, right? And I don't think that there will be enough of the vacation rentals added to the rental supply to compensate for, especially because they'll be entering at a slightly higher level than the ones that'll be dropping out, to compensate for the ones that, you know, the landlords are essentially give up, right? And, you know, give up, they're not going to be foreclosed upon necessarily because they'll still have a lot of value in their property, but they'll give up and sell, so.
Okay, great, thank you. And then changing gears a little bit, what sector do you see absorbing the bulk of the unemployment?
Oh, I mean, tourism and accommodations and entertainment. There's a, as you mentioned, sector of the rental market. You know, we've done quite a few surveys of small businesses here, and you know, over and over and over again, the story is the more dependent your sector or industry is on tourism, on recreational spending, the hardest you're hit, right? And you know, the reality there is that those industries tend to employ a lot of service workers, right? And those service workers tend to fall sort of on the bottom half of the economic spectrum, right? You know, if you're in insurance or law or any of those types of things, you know, you're not feeling big effects, and therefore your job is fairly stable. But if you're in tourism and accommodations, then you're, yeah, that's where we're seeing. We saw this, you know, just it was yesterday or the day before on Lanai, right? We're seeing that these are the places where the most vulnerable folks, the folks who are all more likely to be renting and in the lower half of the rental market, are the ones who are being hardest hit by the economic downturn because of the sector.
Okay, thank you. And just a couple final questions here. Many people assume that tourism will not return to the 10 million level. If it comes back to only 7 to 8 million, what do you see as the impact on rentals and housing prices?
Yeah, I think that's the source of the outmigration, right? If you know, there are really important questions. It sounds like you're dealing with this next time. Is like, how do we build an economy that isn't just dependent on a particular volatile industry, right? And how do we sort of make up for those, recoup that portion of the economy? But that's a longer term question, right? Like even the best idea to be had right now, if we all suddenly agreed on a great idea, you know, just implementing a new sector or a growth sector of the economy is going to take time. And so the implications of tourism not coming back or coming back, and when I say not coming back, obviously tourism's coming back, but coming back at a reduced level is exactly that, right? People who relied on that industry for jobs are going to look around the state, not see other opportunities that fit their qualifications, are going to see those opportunities in California, in Utah, and other places of the mainland. And despite the enormous costs associated with moving, are going to make those moves. And so that's 100% where the outmigration comes from. And when you have outmigration, you have a softening housing market.
Thank you. That was actually going to be my final question on the brain drain, but you included it in that. So I will leave it there. And I want to thank you, Phil, very much for joining us today. That concludes the Q&A portion of this webinar. I want to thank everybody for their continued support as we navigate this new landscape in providing economic education online. We hope that what you learned today has been valuable. Please take some time to provide your thoughts on this event via the feedback form, which can be found in the link in the chat and here on the screen. It shouldn't take you more than 5 to 10 minutes to complete. If you registered, you will receive the link and the materials by email. I saw a couple of questions on the Facebook live stream. So if you registered, you'll get the recording, you'll get the materials, you'll get everything. If you haven't yet registered, you can do so until the end of the day, but please don't delay or you will miss out on that. Thank you for joining us. Thanks to our members. Thanks, Phil, for your discussion. A special thank you to our HEA intern, Sierra Brewer, our HEA VP of Programs, Reen Kamita, and HEA VP of Marketing and Membership, Paul Migliorato, for their work every month on HEA events. Thanks to our returning attendees and those attendees who are joining us for the first time. Please be sure to find the Hawaii Economic Association on Facebook. By sharing our event flyers, you support our mission of promoting economic awareness. And stay tuned for more activity on Facebook. We hope that you'll consider regular attendance at our monthly events. We also hope to see you at our annual conference next month, Finding Hawaii's New Economic Equilibrium on October 7th and 8th from 8:30 to noon. Registration information will begin going out next week. We strive to make our events relevant and beneficial to Hawaii's diverse business community by tackling topics that are pertinent and breaking them down to make them accessible to a broad audience. We hope that you found this to be the case, and we look forward to your feedback. Thank you for your time and attention today. Aloha.